Okay, good morning, everyone. I'd like to welcome you all to the Daily Energy Markets podcast. It's Wednesday, March the 26th. Delighted today to be joined by Jamie Ingram, Senior Editor at MEES, Andy Lavin, Managing Director at Econs, and Livia Gallerati, Senior Oil Market Analyst at Energy Aspects. Livia, good morning. Let me start with you. We've seen oil get a bit of support over the last week or so, and one of the headlines in our bulletin is attributing that to now we're back to supply fears rather than oversupply. I mean, as fast as Trump's headlines are turning, we see the oil market also sentiment turning. Do you think that's warranted?
I don't know if sentiment is turning. There's certainly a lot of volatility in prices, and we saw that very well yesterday. We started off the day on a pretty strong footing, and then by market's close, we lost everything because of the headlines about Russia and Ukraine and maybe potentially a ceasefire in the Black Sea. To be honest, none of that was actually confirmed. I think there's still a lot of things that both Russia and Ukraine need to agree on before there is actually any kind of ceasefire, even if it's just on energy infrastructure. But yeah, I mean, when it comes to supply, there's definitely a lot of things that President Trump in particular is doing that are making some people worried about what the supply picture will look like in the next few months. Venezuela comes to mind. He's just decided to actually give Chevron an extension to operate in Venezuela for another about a month and a half.
But then
So
he's
initially
also
was
come down on Venezuelan exports to China. I mean, this is like obviously one thing here, one thing there.
Yeah,
Yeah.
exactly. And then not to mention also, I have some of my team in the US at the moment, and the big talking point there is actually domestic production. There is a lot of concerns about whether US shale production will be able to grow given the low price environment, and even things like costs of the materials like steel. With the tariffs on steel now, they have already increased significantly just in the last couple of weeks when the sanctions came into effect. Some producers are already feeling a meaningful impact. So there's a lot of people that are concerned about supply availability for sure.
Okay, thanks, Livia. Jamie, let me go to you on that point, but also to look at that from a timing perspective. OPEC, obviously, OPEC Plus planning to add barrels in less than a week's time now. Good timing for them, it seems. Finally, there is sort of a bit of sort of nervousness about, again, Iranian barrels perhaps being pulled off the market in the next month or so. The Russian extra oil isn't back yet, and a lot of people are skeptical as to whether we're going to see a ceasefire. Good timing for OPEC? Too early? Too late? What's your point of view on that? And they kind of also reiterated they're going to continue that into May already. They're saying that.
Hi, Giala. Yeah, absolutely. I'd say that there's still more than a week to go until they start adding the barrels, and the markets at the moment are still being very headline driven. The impact of the upcoming increment from OPEC on prices that was felt with the announcement. So the actual rollout of additional barrels should have a pretty minimal impact on the market, I would say. But as Olivia was alluding to earlier, the sentiment in the market hasn't changed so much. It's more that we're seeing this very headline-driven price reaction. So you get short-term bumps, short-term knocks on prices, and then things seem to be settling back into a just above $70 range. The next issue from OPEC that might drive markets is, again, the fact that they're going to be making a decision soon on whether to continue the monthly increments as planned and confirm that they're going to release the next tranche from May. Certainly at the moment, it seems like we will see steady as she goes on that perspective. OPEC had they flagged up to quite a high degree last week the latest compensation schedule from countries that have been overproducing. Certainly, if that goes ahead as planned, that will more than offset the additional barrels that they'll be bringing back to the market, not just from April, but from May and June as well. Nobody expects that compensation plan will be fully implemented, but it's trying to send that message to the market that, hey, we are not going to be flooding you with additional supply anytime soon, that we have the mechanism in place to limit the amount of barrels that are coming back onto the market.
Yeah, there's definitely been some headlines about compliance, haven't there, in that
Yeah.
compensation plan. Thanks, Jamie. Andy, good morning again to you. I mean, that's just sticking to not the OPEC thing, but I mean, again, Russia. and Russian oil on the market, obviously. We had, some headlines out of the FT Commodities Summit yesterday, which was obviously full of traders, and all of them expressing, yes, we'd buy back into that market, but not until things are really, really clear cut, and there's still a lot of uncertainty, and it'll take a long time for Europe and the US even to agree on that, given the current relations. What's the sentiment around sort of more Russian oil coming into the market? What would that do, if at all, if anything, do you think, to the outlook really in the second quarter? If obviously assuming it happens, yeah.
Yeah, and your point at the end there is the critical one, right? So fundamentally, there is not a problem with supply. It's purely that people either are choosing not to produce it, which is OPEC, are being prevented from producing it and selling it in the market, like Russia, or are being told not to produce it and sell it in the market, like Iran and Venezuela. Otherwise, we'll put tariffs on. So you've got very competing things going on. I think the reality is, and you can see that in some of the reporting out of the ceasefire conversations between Russia and the US and the Ukrainian US, there really is not a consistency of story. And I think one of the things that we'll find is that we may well see US and Europe going down two different roads in terms of how quickly they're willing to pull back on sanctions, because they've got competing agendas. The US agenda is, how do I make the economic environment better for me? The European agenda is, how do I make Europe safe for me? And those don't actually come together with just saying, oh, well, now we've got a ceasefire so we can release the sanctions. So I think sanctions, certainly from a European side, are going to be there for a lot longer. And I don't see Russian barrels really coming back into the market most of this year, to be quite honest.
Yeah, and I mean, we had a survey question just up earlier, just a small survey of, do you think we're going to see even a ceasefire this year? And actually, by a blip, the majority said no, despite the sort of, the headlines I said that are coming out. Livia, but what does that tell us then about oil price direction going forward? Yes, we've seen some support recently, and it's kind of, pretty much been in a stable around the $70 range. But a lot of people also in the market saying second half of the year, with the US economy maybe going into recession, we're looking at a new lower band, 60 to 70 or even 60 to 65, possibly. Is that something that you feel that could happen given current sort of market outlooks?
I don't know if there is too much downside versus where we are at the moment. I think moving significantly higher will be challenging as well, because the concerns about the economy are real. I wouldn't say there are some people that are saying that we're already heading into a recession and things are really bad. We're not quite in that camp, I would say. But there's definitely signs of some kind of a slowdown. Some of the data coming out of the US hasn't been great. So yeah, it's very difficult to rally when the macro background is not exactly constructive, right? But to the downsides, look, as we were saying, yes, there is not a problem with supply in the sense that, except I would say the US, where there is really a geological issue, like the best acreage has been drawn down, and it's a lot more costly to develop the tier 2 and tier 3 acreage. When it comes to the other countries that are having supply issues, they are more geopolitically driven. So production in Iran, production in Venezuela, that could potentially come back if Trump wanted to, but it doesn't seem like he really wants to, right? We, for instance, expect fairly significant production losses in Iran in the coming months as the US administration tightens the screw on sanctions. And, we've seen even just last week, they targeted a Chinese teapot directly for the first time. That's a pretty telling signs that they're what they call their maximum pressure campaign.
Yeah.
On Iran is real.
What would you classify as significant volumes from Iran? 500,000 or more?
Yeah, I mean, it could be around that, both in terms of upstream production and export losses. Honestly, it could even be more. It's very difficult to put a number on it. But what we are hearing from the market and talking to some of our Chinese contacts in particular, they are very concerned about purchasing uranium volumes at the moment. So they are looking for alternatives and they are staying away from those barrels.
Okay, thanks, Livia. Jamie, we mentioned a bit the US economy. There have been downward revisions on GDP forecasts in the last 2 weeks, on the back of the whole tariff, consequences, let's say, as they come into play, as they maybe don't come into play, this confusion. But let's talk a bit about the Gulf economies. I mean, in terms of where the oil price is, Saudi in particular, it is obviously now probably accepting that we're not going to be getting a lot more than $70 Brent, for the few months ahead. How is that impacting, do you think, thinking in the country in terms of budgets, expenditure? That's below their budget, balanced budget figure, isn't it? And is there any signs of nervousness there in terms of whether that's a strong enough price?
I tend not to put too much of an emphasis on the current oil price versus, this break-even oil price for the Saudi budget, for instance. For one thing, Saudi Arabia has still got very low debt to GDP levels. They can afford to borrow. They're very willing to continue to borrow. Vision 2030 is obviously taking up a lot of investment from Saudi Arabia, but the whole rationale of Vision 2030 is to further reduce this linkage between the health of the global oil market and the health of the Saudi economy. So quite frankly, with oil prices being consistently below the break-even point for their budget, with them consistently racking up deficits, that only further strengthens the rationale behind Vision 2030. I think that is recognized in Riyadh, the fact that this shows that they really do need to be investing in diversifying their economy. That's the key driver for us as far as we see things in Saudi Arabia. Yes, the situation is difficult. Interest rates are a struggle for Saudi Arabia. That when you are borrowing, you don't want interest rates to be consistently high. But the big thing is FDI. Vision 2030 has always been a structure that is heavily dependent on bringing in foreign investment, bringing in foreign expertise. And at the moment, they're still struggling to gain traction on that front. That's why we're starting to see some of the reports on big capital projects in Saudi Arabia being scaled back. It's that the foreign counterparties are still a little bit reticent to inject as much capital into the kingdom as Riyadh wants.
Okay, thanks. Andy, just sticking to a sort of OPEC also an oil price, but on the market share scenario, because yes, we've got compliance issues. We've had obviously Saudi and a few others holding back barrels. We had somebody on the program this week arguing that actually OPEC and Saudi, it's in their interest to add barrels, bring the price down to a lower range of 60 to 65. To encourage demand, to encourage Chinese consumption for storage, to encourage US to refill its SPR, and therefore obviously giving producers like Saudi the advantage over the non-OPEC ones from a cost point of view. Would you say that's a strategy that they could be looking at now, particularly because the concept of market share is becoming a bit more sensitive after 2-3 years?
I think they've got a dilemma for a variety of factors, and the different countries have different pressures as to how much they need or how much they want from the barrels they're selling. I think you go back to one of the old oil ministers from Saudi Arabia, and he was very clear with OPEC, and this is something that OPEC has moved a long way away from. He said low oil prices are our friend because we are the cheapest supplier. It drives demand. At low oil prices, nobody can compete with OPEC. Well, certainly the Middle Eastern members. So low oil prices are a benefit, but they've also benefited from significant oil prices, which has allowed them to grow their budgets. And now they do have to worry, even if it's in the medium to long term, they do have to be worrying about how they balance it. So it is this inevitable balance of how much do I produce and how much do I pay per unit? What they're looking at is my absolute number. How do I actually maximize my absolute number? And at the moment, in all honesty, all they can do is let's just continue and not worry about all this noise that's going on around us. Are we having tariffs? Are we having sanctions? Oh no, we're not having tariffs. Oh no, we're having something else. Oh, no, you can't do this. You just ignore it and move forward. And I think that's kind of the underlying sentiment today, which is not worry about the noise. We've got no idea what's really going to happen. Just keep moving forward and be sensible.
And keep things stable, I suppose, which is
Yeah.
what they've been accredited for doing, obviously. Livia, let's talk a bit about LNG. We've got a couple of headlines there. Tight LNG, contrary to oil, LNG is a bit tight. Prices are being supported there. European storage levels of gas are at not record lows, but lows for this time of the year. Again, 30-something%, and they need to obviously build that up to close to 100 ahead of winter. Any concerns? I mean, in the context also of the Russia pipeline gas, that's obviously Europe is still taking a bit of, but the hesitancy to go back to that. Where's the health of the LNG market at the moment, do you think, going into summer as well?
I don't follow LNG so much these days, so you're putting me in a tough spot there. Look, I think the same concerns apply as to the oil market. I think when it comes to Russia and Ukraine, it's very difficult to see a deal being done soon when it comes to peace. Although I would say there is maybe a little bit more willingness and interest on the gas market opposed to the oil market in bringing some of the Russian pipeline gas back to Europe. Some conversations with people in that sector, to me, have suggested that. There's still concerns of oversupply when it comes to liquefaction capacity, with some more projects coming online in coming years, especially now that the Trump administration is a little bit more friendly to LNG than the previous US administration was, perhaps. But yeah,
I mean,
the market I follow so closely these days.
Yeah, it's just an interesting concept in terms of, because you've got the US LNG that was supplying into Europe in the midst of obviously the Russia-Ukraine issue, but that Europe is perhaps not going to struggle to fill up also its storage ahead of the winter. It was just an article that had come up. Livia, then sticking with you, let's talk a bit about oil refined products, maybe, and at the outlook for the second quarter. A lot of people saying that those cracks are going to follow crude in whatever direction crude goes. What is the health of the outlook sort of for gas oil, given economic outlooks, and also jet fuel as we go into summer, and even gasoline demand that starts to pick up obviously in the second quarter?
Look, actually, there is maybe a little bit more hope to see a bit more upside to the products market compared to the crude market in the coming month, which then actually is good news as well for crude, because if you have a product-led rally, you actually can see a little bit more upside to crude prices. Just taking gasoline, for instance, the big thing that the market is waiting to see is whether, particularly in the Atlantic Basin, is whether the Dangote refinery actually can operate at full capacity, because that would bring a lot of new gasoline supply to the market. It would considerably change trade flows, etc. Now we know there's been ongoing issues just very recently at some units, some unplanned outages, planned outages. They're definitely not running as much as they should be at this point. And when you're looking at things like FCC cracks, so secondary unit cracks, which are very important for gasoline, they're very low. And should they remain at these levels, you actually wouldn't incentivize very high gasoline production in the summer. Which is typically when demand peaks, particularly in the Western Hemisphere. So you take these factors together, low FCC margins, issues with Dangote, etc. You're actually set up for quite potentially some upside this summer. So it's an interesting opportunity and potentially something that might support the oil complex in the coming months.
Okay, thanks. Certainly looking a bit more positive than it has been the last few months. Refineries have been struggling. Andy, let's talk a bit about China and Chinese demand and any support that it continues to lend to this market, stimulus plans continuing, but has the market now adjusted to a new normal for China this year? No expectations really, which are going to be beyond, unlike last year where there was heightened expectations on how much that would support the market.
Yes, I think so. We went through a bit of a pendulum cycle at the beginning of the year when it was, oh my God, they're going to be a basket case. Oh no, they're not. They're going to be really good because of all the stimulus. And I think people are now recognizing it's probably not going to be either of them. It's going to be, yes, they're going to get support from the government when they need it, but they're not going to shoot the lights out. But equally, they're not going to be a basket case. So it is really steady as they go. And it's all about where are they going to get their supplies from. And the challenge for them is if they get forced away from cheaper supplies, which what they've been benefiting from, their costs are going to go up. So that probably will be a little bit negative, but not, I doubt, on a major base though.
Okay. Jamie, let's talk a bit about non-OPEC supply if we can. I mean, we touched a bit on US production at these prices and what would happen if prices dropped. But, again, disappointment last year from the likes of Brazil. And then you've got other headlines saying, no, non-OPEC supply will be quite healthy this year in terms of the Guyana, Brazil, even US production. Different arguments being made there. Is OPEC, do you think, factoring that a lot into their thinking? Again, going back to the same question, or they're just going to go steady as she goes, was focusing on, keeping things stable no matter what others might be taking advantage of, obviously, in us supporting that price?
Yeah, there's obviously debates within OPEC about the extent to which has their strategy helped to bolster rival supply coming onto the market. I'd say that looking ahead, OPEC is and the OPEC Plus group as a whole is currently thinking we're starting to see a slowdown in the US supply growth coming onto the market. We're not talking about it having peaked just yet, but we're not seeing the huge supply gains that we saw coming out of the pandemic, where they were adding hundreds and hundreds of thousands of barrels a day to the market over a very swift period of time. So there is definitely a perception within OPEC that if they just stick to the course that they're on at the moment, they will start to emerge, probably not in 2026, but perhaps by 2027 into a position where they can have the combination of increased market share and also higher prices. That's really that's the ultimate goal for them, of course, is to move out of this position where they're having to have all these trade-offs, which are causing some disagreements within the group over strategy. Nothing that comes to the surface too much recently, but they are having to balance these different positions within the alliance. So the outlook is a little bit more positive as far as they're concerned, but they will have to go through a sticky patch, certainly in the second half of this year, where we might start to see the additional growth out of Guyana, out of the US, probably not so much out of Brazil, to be honest, impacting prices as they start to try and bring their own volumes back onto the market. So near term difficult, but medium to long term positive for OPEC.
Okay. Livia, I mean, let's talk a bit about, again, how geopolitical risk is playing into prices these days. We saw over the last year, it not really factoring in too much. Yes, headline driven blips up and down. We have seen the breakdown of the ceasefire in Gaza in the last week. To all intents and purposes, we still see, we've seen the US action on the Houthis in the Gulf and Bab el-Mandab, and yet the price, maybe is not reacting that much. Is there any nervousness that things could escalate on that front? And Iran's card at the end of the day that's Iran's card, isn't it? To play with those critical sort of choke points.
Yeah, absolutely. And look, I think the market needs to see some kind of tangible supply disruption before it gets reflected in the price. If anything, the events of the past couple of years have shown a few people that overreacting to geopolitical headlines doesn't necessarily play well. We saw after the invasion of Ukraine, prices went through the roof in expectations of a big loss of supply from Russia. That never actually materialized. On top of that, the US released very large volumes of SPR and everything came crashing down. So if the recent history shows us that maybe it's not a good idea to get ahead of some of these geopolitical events until the supply disruptions are actually materialized. And I think that's very much the case when it comes to pricing in any Iran-related supply losses this year. I think there's a lot of people that are concerned about that, particularly in the East. But we won't see that in the price until we actually lose some supply.
Until we actually see it on the ground. Andy, are we overreacting to tariff headlines? I mean, overreacting to geopolitical risk, but what about tariff headlines? I mean, it's been a huge, obviously, theme in the last month. Are we going to see some complacency there, do you think, going forward, as we have seen, for example, as the Russia-Ukraine war kept going, and even as the sort of conflicts in the Middle East also continued?
Simple answer, yes. I would love to know what the percentage of tariff announcements have actually led to tariffs. My sense is it's not very high. So I think what you're starting to see in the broader world is people that look at what the US administration is doing and saying, well, yeah, but they're saying it, a bit like Livia said in terms of supply disruptions, but until they actually do something, they're just saying it. So I think tariffs are there. They're clearly something that the US administration likes and feel is useful. But until they actually come into play, I don't think anybody is doing anything other than saying, okay, yeah, I need to watch out for that. And that's it. I don't see them really impacting the fundamental pricing, but people will think about, okay, does that mean in the short term I need to be a bit more diversified in my supply, just in case, because I don't want to be caught out if it happens.
Okay, Jamie, let's just talk a bit about sanctions again on Russian oil, because we saw, again, there's no new deal done yet, but we did see in the new year the OFAC sanctions coming into play at the end of January, admittedly causing a little bit of an impact to some of the vessels. But again, the sort of, and with the price now having softened a bit in the last quarter, getting closer to the price cap of Russian oil. I mean, are we still continuing to see all things remain the same on the dark and shadow fleet? We don't expect to see any changes there in terms of those vessels getting to where they need to go.
Yes, certainly. For now, under the current sanctions regime, things have stabilized to the position where those people who want and are willing to buy Russian crude and products are able to do so with the shadow fleet as it is, with STSs in various locations around the globe. That system is in place. The question was always about, were some of the comments from the Trump administration when it came in that were a bit more aggressive towards Russia than were expected, was that going to translate into any sanctions? Clearly, there was a very swift change in the mood music coming out of the White House after those initial days, and nobody's really expecting there to be any additional restrictions on Russian products flow, Russian crude flow coming out of the White House. As Andy was saying earlier, there is definitely going to be a bit of a two-track position coming out, a divergence between the US and Europe, should we get to the stage where there is some sort of ceasefire in Ukraine, which we are a long way away from, I think, at the moment. But certainly as it stands, we're not expecting to see any tightening of sanctions.
Okay, thanks, Jamie. Livia, let's just talk a bit more big picture macro. I mean, another thing that does impact the oil price sometimes is obviously US Fed policy, interest rates, the inflationary environment, whether it's in the US or Europe, or indeed here in the Gulf. We were paying a lot of attention to the oil market was paying a lot of attention to US Fed policy a year ago as there was more activity on rates, but not so much activity these days. Is that something that the market is looking at closely at all?
Yeah, I think what is going on with the economy is always going to be very important for oil prices, particularly if the dollar moved, and oil tends to move in the opposite direction, right? But yeah, I mean, the last Fed meeting didn't share anything necessarily that the market wasn't expecting. If anything, the economic outlook that the Fed laid out as their base case was maybe a little bit more optimistic than one might have expected. Now, with the big caveat that they clearly said that it's just one of the many possible outlooks, and much will depend on what happens with tariffs, etc. So there's still a lot of concerns in the market, and I think a lot of the pressure that we've seen on flat price in particular has been driven by the macroeconomic fears. So I think that's very much something that the market still watches and is still very concerned about, particularly on flat price. On spreads, however, I think that's where more like the micro fundamentals of specifically oil markets are coming into play. And we've obviously come off seasonally a little bit on spreads, but it's interesting that we still managed to remain backwardated across the three main benchmarks, even as we're pricing sort of what is normally the softest period fundamentally for markets with refinery turnarounds. Even for light crude benchmarks, Brent and WTI, where we know there is an oversupply problem on light sweet crude, whereas sour markets are a lot tighter. But even those two have remained backwardated, which is to us, it's a sign that underlying inventories are tight, and you're seeing that at Cushing, but you're seeing that in other parts of the world as well.
Of course, and of course that backwardation has been one of OPEC's sort of targets, isn't it, to keep the market backwardated? So they seem to be succeeding on that front as well. Thanks, Livia, and thank you to Andy and Jamie for joining us this morning. It's been great to have you. There's an interview coming up that we did earlier this week on Halftime Talk, coming up in an hour, again, talking about the sort of supply scenario in the market and the various factors influencing that. So well worth watching with Sarah Emerson. Thanks so much, everyone. Have a great day ahead. All the best.
Thank you.
Thank you.